afternoon, everybody. This is Thursday, the 7th of December, just after Santa Claus in Europe. That's fine. So, in today's live stream, we're going to talk about the drastic drop in job openings, the UK construction sector, for example, because that's in trouble, the slowing US economy in general, and why the oil is in free fall. And after that, only for pro members, we're going to check out the live charts and charts as well. So let's start with the macroeconomics, what happened this week since Monday. Now, if we take a look, we can see that on Monday, as I told you, there was a Japan monetary base decline just a little bit, 0.1%, and the CPI in Switzerland fell down to minus 0.2%. Since then, we got the US factory orders, which was a little bit up, and it was actually revised, a little bit down. I just forgot to take the minus there. As you can see, this is minus 3.6%, which is a huge decline. And this will be a very important information in the explanation what I'm going to give you about the job openings as well. So technically, we got a 2.8% previous, then this has been revised to 2.3%, and the new data become, as I said, I just forgot to put the minus, but it's minus 3.6% down big time. And then we got Tokyo core CPI, which is declining very nicely, just as everywhere else and globally. That come down from 2.7% to 2.3%. The Australian cash rate stayed the same, which means that for 4.35%, the CPI, the monthly CPI from Switzerland, as I told you, that was reported before, that minus 0.2%. The US ISM Services PMI is a little bit improving. That was 51.8, and we got 52.7, as we see on the chart. This improvement is just improvement compared to the previous data, which is important for short-term traders. But in general, we still have the declining trend, which is slowing in decline. But of course, we don't want to see that it starts to accelerate to the underneath the 50 points again. But it's a slowing economy in terms of services sector. So no big change here. But here's the first very important data, the US job openings, which was 9.55 million, and then it has been revised to 9.35 million, and the new data come out of 8.73 million, and that proves the continuous decline of what we are experiencing since the middle of 2022. And there's no change in the trend. So this two spike, what we experienced here, probably some seasonal acceleration, but that's a big problem. Now, what could be the reason, or what could be the problem with this drastic drop in the job openings? Well, first of all, if you're just thinking how the economy works, first we need, of course, mining any kind of commodities, and then we need to produce something out of those commodities, which is the manufacturing sector and the industrial sector. And then if we can take that in terms of we're making an analysis how much the demand is for those products, and then we start to manufacturing those products. And if we did that, in the meantime, we pick up more people to manufacturing them or selling them or whatever. And if we see that the job openings is declining in trend big time, that means that the US economy does not need as much, additional job in the economy, which is a problem because that means there is not much manufacturing activity in the economy as well. So the problem, what we're creating right now is that even if we see the job openings decline, this is a sign of the declining manufacturing, and the problem with the manufacturing PMI, for example, what we are investigating every single week is that we can prove that serious decline not only in the United States but in globally. So technically, that's a perfect proof of a very bad start of 2024, because now what we see is the declining manufacturing, the declining industrial work, which means in 2024, we must expect a declining and then slowing revenue growth in terms of companies. And that could be a problem because in the new phase of the probably couple of decades long interest rates and inflationary period, I think performance will be watched more likely in the stock market rather than the growth. And obviously the two is depending on each other, but still. So if we start the next year in a very bad period that we are continuously declining, as long as we don't have a trend to the upside in the manufacturing, that means that this will seriously hurt companies. And that's the problem with the slowing US economy. So it's still slowing down. It's not improving. I understand the hype around Christmas, but even the Christmas shoppings are showing, deceleration compared to the last year, which is a really, really big problem. So I expect the Q1 and the Q2 earnings showing a declining revenue in almost all sectors, and this is a main problem for that. But moving forward, we also got on Wednesday an Australian GDP, which is declining to 0.2% from 0.4%. That's okay. I think it's natural because we got that very high interest rate environment. So that's the goal of the RBA. So no surprise here. But of course, this is a very negative information and a very negative effect to the Australian dollar, as we saw on the index chart anyway. And we got UK construction PMI, which came down from 45.6 to 45.5. Now, that's a problem. The problem is not the 45.5 itself or the change compared to the previous number. The problem is that we got 3 consecutive months, not only below 50, but around 45 points. And that means that what I mentioned a couple of months ago, that is expected in the United Kingdom, that the construction sector will drastically slow down and probably opening 2024 with no work at all. This could mean, an acceleration of selling used houses, and then because we don't have the supply in terms of we don't building new houses, probably at the end of 2024 there should be a very high inflation in terms of house prices. So if somebody is thinking about investing in housing sector in the United Kingdom, that could be a good opportunity. But we have to wait for that, of course, because that's a slow process thing. But we see the sign, obviously. And because we know exactly that the UK economy is in a very similar situation than the United States economy. It's slowing down, and of course they have to keep up on a certain level a little bit more actively than in the US, but it's still a slowdown, and restart the economy after a slowdown like this is not going to happen like from January to February. So that's also a slow process. So this supply backdrop in terms of the houses will definitely affect the housing sector probably from the end of 2024. So I think it's worth to watch. It's really worth to watch. We clearly see from the numbers. And then we got ADP non-farm employment change, and that's because, we're going to get the non-farm payroll the day on Friday, and that's a very, very volatile day. And every single non-farm payroll Friday is coming just right after Wednesday ADP non-farm employment change data, which was 113K, and then it has been revised to 106K, and the new data become 103K. So there is a definitely there is a decline in terms of employment change in the United States. And if you take a look on the chart, even the small climb what we saw last month was just not good enough. And this is lower than expectation, lower than the previous. So it's a very negative thing to the DXY and to the US economy, obviously. But it's even worse for the US companies because that also signals that they just don't need as much employees as it needed a couple of months ago. So we are slowing down. We're definitely slowing down in terms of performance as well. And then we got a Canadian overnight rate. There is no rate hike this time. So the 5% stays, which is not, it's not too good for the Canadian economy right now and the Canadian dollar, because that means that the economy started to slow down. So the Bank of Canada can a little bit longer pause the interest rate hikes, and we will see later on whether we need more hikes or not. The US crude oil inventories came to minus 4.6%, and this is a good news actually, because as we see, the oil market is a little bit in panic mode, and the previous data was 1.6 million, as I mentioned to you. The problem with the crude oil inventories is the trend what we're experiencing from almost the middle of the 2023. And that rising trend tried to signals that there is more oil in the economy than it needed, which means that the supply is larger than the demand. So this is something we need to do, or American people need to do something with that. But the minus 4.6 million means that there is a reduction right now, and this might be developing in the right direction. But again, changing supply demand in terms of oil, it's technically a quick process compared to other commodities, but it's still, we need to wait the effect of it. And obviously, the United States is pushing down the prices of oil now intentionally, just to make sure that they stabilize the prices on a very cheap level. No surprise, because they're preparing for 2024 elections and etc. etc. It's winter time, so obviously we need cheaper energy than it was before. But at the same time, this cheap oil price is unstabilizing for the long term, and so it is a little bit angry. Now, we got the usual decision by the OPEC Plus that they will further cut oil production, but as we saw on the charts, that didn't help, because the problem is even deeper and deeper. Now we start losing the control over the oil with this cat-mouse game between the OPEC Plus and the United States. So I believe there is a need for a more drastic change in terms of the control of oil prices. So technically, this data is supposed to be positive for oil, but the oil industry right now is just not trusting this system anymore. So there are changes coming, that's for sure. So this is what happened yesterday, and I just wanted to highlight that the two Chinese data what we expected today, this is the CPI and the PPI, has been delayed. So we're going to expect them to come out on Saturday, and on 1:30 p.m., which is not just yet, but in half an hour, we're going to get the US Challenger job cards data, which I already explained why it's important. But if somebody don't remember, go to the website and you can check out the analysis about this data. So, by the way, it's a little bit more than I made analysis on the website, but all of the very important data analysis can be found for advanced and pro members on the website. Don't forget to check if you haven't done just yet. So technically, we not only get the confirmation what we suggested a couple of months ago, that into which direction we are developing, but this is showing us a very strong signal that the economy is developing in a way which is, it's placing a negative pressure, especially on the stock market. And therefore, when we are calculating with the points, with the overall points, the macroeconomic effects on the ETF and the index market is actually coming down. This is coming down with 1 point extra. And as you can see, that negative, or you will see in the overall points, that negative effect is very important right now, especially right now. But if we take a look how this macroeconomic situation is affecting other market sectors, for example, this is a neutral effect on the commodity market. And the reason why it's neutral and not positive, because it's supposed to be positive, because that macroeconomic environment is creating a strange supply demand balance, I rather say, because when we're reducing supply, that means that we can actually raise prices. which means inflation, and therefore it's supposed to be positive. But this effect is it's a slow process in terms of the commodity markets. We need to see the results a little bit after. So if we reducing manufacturing, then we need a couple of months to transfer this positive effect towards the prices of commodities. So therefore, it's still neutral on a very positive territory, by the way, on 17 points. But we still expect some rising in terms of the macroeconomics, but probably not right now. Maybe in a couple of months, what we will see. In terms of the forex market, that's another interesting situation because it's still neutral. Forex market will not react for the slowing manufacturing right now because it's already calculated in the prices. It's already calculated with the strategies of banks. And therefore, the forex market will only having some reaction for the financial macroeconomics, and therefore, as long as we don't see the change, for example, in the money supply data, or as you might remember, I already warned you that next week will be a very important week in terms of the rate hikes or rate decisions. And so this is all financial related macroeconomic data, which we are really waiting for, and the forex market is also waiting for. So we should expect some changes in this point in the forex market, maybe the end of next week or the beginning of the week after. So this is still neutral. In terms of the stock market, obviously it's a negative effect. So you can see that we are declining 1 point in the negative. It's almost full power now. The maximum of responsibility for the market moving is 17% by the macroeconomic effect. And we're using right now 14% to the negative side. So it's a very strong power on the stock market right now. Which, by the way, it's a long-term power, so we should not expect that it will ease anytime soon. And if we take over, or if we go over to the crypto market, as you can see, it's still neutral in the negative territory. And again, this is very similar in that matter, very similar to the forex market. So this effect will coming from the financial side and not the manufacturing or services sector side to the crypto market. So we have to wait another 1.5 weeks ish to see the result of it. So let's go forward. There is no change in the geopolitics right now, but we are closely watching the advance of Russian military inside Ukraine, which got a little bit more power in the last 1.5 weeks. And also we are watching the development in the Middle East, but so far there is nothing would change the market reaction in terms of geopolitical or reaction for geopolitical developments. So I'm not going to show you through, but technically every single market sector is reacting in a neutral way. It got exactly the same point what it was in the last meeting. And so there is no changes here. Also, no changes in the corporate earnings because we are waiting, or we will waiting for the Q4 results beginning in January. So this will be a very interesting result. I think there are companies with the opportunity to play around with the numbers still, but it's undeniable that we already have the consumer spending decline starting to be visible in the balance sheets and the cash flows. So I think the Q1 is the earnings season, which is going to bring the very, very sad and very bad results. Now this is about company performances, but the market reaction could be quicker because if the investing community is smelling the problem already, then they will react earlier than they will get the results with the earnings report. So probably the market will start to react in about January, February in a negative way. So that's at least what I expect. But there is no changes in the point so far. And in terms of the market news and events, this is an interesting story. So let's start with the ETF and index and stock market. Now, the news are important because news are driving the narratives of the retail traders. And, there's a lot of retail traders, and sometimes they're making stupid or bold things. For example, a very, very stupid rally to the upside based on AI mania, which will be destroyed next year, by the way, just so you know. So expect the AI going down instead of going up next year. First of all, with the last live stream I made on Monday, I was talking about the possible, turn and negative effect in terms of the company performances. And I told you that we can expect the unemployment rates start rising from January. If it start rising from December, that's even even worse and even quicker. I don't wish that, but this is something we can't avoid. And just right after the live stream, I think a couple of minutes after the live stream, one of my team members just posted on the website that Spotify is about to cut 1,500 jobs by the end of the year. This is by the end of the year, so this is technically shocking. So every single company, even the services sector, is really, really feel the consumer spending decline. And therefore, the only way, because so far they started to play with the numbers, they increased the prices, excuse me. And by the way, Spotify increased the prices as well because they experienced this consumer spending decline earlier, a couple of months ago, and that's why they played with the inflation. So they increased the prices because they tried not to fire anybody or try to keep up the business. But they can no longer increase prices. That's not an option anymore because nobody buys even the cheap products and services, not even the expensive ones. So the only way to react for that is actually leave the prices on pretty high level and then start firing people. And this is exactly the way what we're going to see right now. And Spotify is starting very early, but we already got the news about banks and other sectors that they're doing the same. For example, European bankers face job cuts because of lower businesses in 2024. So they already see what 2024 will be, and it will be a very, very bad year, and it will be very uncomfortable for everybody. So this is the new trend, and we need to get prepared because this trend will give us opportunities on the market, but we need to understand how this is going to play out. And once we do, we can use the opportunities, and that's why I'm making those live streams to you, so make it easy to understand. Now, this is a big shift in the narratives because so far what we hear here is the AI mania, all positive. Look at that, Nvidia is the best business on earth. They're doing perfectly. Record high revenue, which was a fake revenue anyway, but I already explained that. And if you're wondering what the problem is with the Nvidia earnings, you go to the website and check my analysis about Nvidia Q3 earnings. And in my analysis, even then, when we got this report, I highlighted that there is the consumer spending decline. There is no more. There's no increase in terms of sold products about Nvidia. And if Nvidia struggles, then other companies are struggling as well. So you need to be prepared. I understand this pink cloud on the internet and in the YouTube videos that, oh my God, the economy is good, so now we can start and buy and invest and hodl. That's not going to happen. You will fail if you're going to do that. But of course, you do whatever you want. I'm not telling you what you're supposed to do. I just want you to understand what the economy does right now and where it's heading to, so you might get, a better decision in terms of using the market. Now, that doesn't mean we can't use the market, because the market will give us plenty of opportunities, but not necessarily on the stock market, or maybe on certain sectors, which I already had a post on the Discord server what I'm going to watch in 2024. So if you're clever, you can use this market. But if you don't, and if you're just stuck in this pink cloud thinking, then probably you're not going to be very successful. But that's everybody's own business. So other news, which is very strange in terms of the stock market and the ETF market, is that EU states will begin negotiations on Ukraine's accession on Tuesday. So now that's an interesting story because Ukraine is fighting for joining to the EU for a long time now. And if they accept this, this will 100%, this will just create more tensions between NATO and Russia. So let's just watch this very closely. And I'll be honest with you, I'm not hiding anything from my viewpoint. I do not have problems with Ukraine, just in advance, just so you know. In fact, I have very, very good friends, Ukrainian friends, and some of them very close friends. And we agree, even Ukrainians agree with that as well, that Ukraine should not join the European Union right now because this will create so tense situation between the European Union, the NATO, and Russia that it will be very hard to avoid any serious consequences. So I think it's a stupid thing. It's a bold thing, and in that matter, I 100% support the probably the only one. I hope it's not, but as far as I heard, the only government in the European Union which opposed to this decision, and that's Hungary, and that's the Hungarian government, and I am really supporting them with that decision because this is a very, very bad decision from the European Union and from Ukraine as well. And the strange thing is, of course, I don't know all Ukrainian people, but as much as I know, almost technically all of them thinks that this is a very bad idea, and it's not. It should happen later, when the relationship between the EU countries and Russia stabilizes and improving a little bit, and then probably we can do some kind of talks about let Ukraine join to the EU if they really want, but not right now. If we do right now, there will be more problems, and I don't think that many people will be happy about that. Now, here is something really, really worth to watch. I don't know if I'm supposed to say the good news first or the bad news. Now, by telling you the good news, Toyota plans to expand its range of battery electric vehicles in Europe to 6 models by 2026. So this is the next 2 years, actually, which is a good news because the thing is that I just told you on the Discord server yesterday that I believe that the stock market will be judged by company performances and not growth, what we experienced in the last 2 decades. This was a very good strategy to investing stocks in the stock market that follow the growth, and wherever the growth is, you're going to invest there. But this story ends here right now because the environment is changing, the financial environment is changing. In the last 40 years, we had a trend-like declining interest rate period, and also a trend-like declining inflation period. But this is about to change now. We hit the bottom actually with the 0% inflation, even in the United States earlier, and the 0% interest rates. There's no lower. You can't go lower. Technically, you can't go lower, and this is a cyclical movement, and because this is how the economy is just developing, and it is obvious that for the next at least 2 decades, we're going to experience rising inflation and rising interest rates. So we're not going to get the rates back to 0%. If somebody believes that, it's on a very, very bad track. There will be rate cuts, and there will be declining CPI numbers and any kind of inflation numbers. That's obvious. I'm not talking about that it cannot go down. It will go down. In fact, it's going down right now, but I told you last week the reason why. But what is going to happen, then it's going to, if you take a look on the chart, it's going to create a higher low level, and then it starts rising again with a new higher high. And that's the trend what we're going to see in the next 10 to 20 years at least. both in inflation and interest rates. So therefore, company performance will be very important because investors are going to think on a different way than they did in the last 40 years. So you can imagine that that was a 40 years trend on the stock market, and everybody got used to it. Even me, I was learning that system. I was raised in that system, and now I have to adapt to a completely new market environment. And I tried to prepare myself in the last couple of years because that was very obvious that we're going to go in that direction. I was also trying to communicate with the public, but obviously everybody just spit on me. No surprise, because I understand why people don't believe, because everybody's living in pink cloud, and not everybody understands how the market is working. But every single word I said previously become true, and that's not because I said, but that's because, and it's not only me, by the way, who can read the economy, but there is a ton of economic analysts that can actually have a good read on the economy. That's we are right, not because we are so clever, but because we see what is going on and where we are heading to. And so if Toyota is planning to do this in the next 2 years, that means Toyota have enough power to invest into Europe with those electric cars. And that means good performance, at least keeping up some kind of level of performance, even if hard times are ahead. Cars are always needed, and there will be a time when the price of cars will come down a little bit, will adapt to the salaries and to the earnings, and it will be easier to buy a little bit. But I think this is a proof that there is a company that really preparing for this environment, and I think that's something worth to watch in the next couple of years. And there is a bad news as well. The U.S. consumer spending is slowing down in today's. That was on 30th of November, by the way. Then at that time in the macro data, and this is a shocking information because what is happening that we just after Black Friday, we have the Christmas time, the preparation, everybody supposed to go to shopping. And unfortunately, I can't show you this publication right now because I forgot to cut into the press document. But there are news channels are reporting record high Christmas time sales in shops. But with those headlines are really lying, because if you go there and just reading the lines, you can figure it out that actually there was 1 day growth which was a record high growth within 1 day, but the entire sales are actually dropping back compared to last year. It's smaller than last year, so we are decelerating the consumer spending in Christmas time, and this is a very bad news for the economy, because that proves that we're going to start 2024 on a very painful way. And I hope everybody starts to accept this, because if somebody don't see that we are just, at the tip point of the stock market, then so many people will cry again. And I just hate to see this because anyway, you know that. So overall, this is a very negative pressure, very negative narrative to the ETF and the stock market. And therefore, if we go to the points of the ETF and the ETF, you will see that the market news and events is declining from -3 to -4 points, and it probably will continue to decline in the upcoming weeks and months, maybe, because that's what we're gonna get news. We're gonna get negative news to the stock market. That's for sure. If we take a look on the stock market, you see that we are declining from -4 to -5. So it's that's a very negative pressure on the stock market. And by the way, we already get two of the very negative. So we got macroeconomics, which is negative. We got geopolitics neutral, corporate earnings neutral, but in very negative territory, by the way, both of them. And then we got the declining market news and events. So it's a net negative effect on the stock market. If we go to the commodity markets, we got a declining news, and why we got a declining news points, actually. It's still in positive territory, but it's declining. And why? Because it's declining for a long time, by the way. Now, if we go here and take a look what's going on with the commodities. The problem is that there is no major news in terms of metals or food. In terms of the food, there will be some because, the Ukraine war is developing week by week. About the metals, there's not much to write, but only, gold got a rejection at the all-time high, but what a surprise. Come on. Who was expecting that broken for first time? So that's just, we should hold back our horses. So nothing really extra extreme to write about metals right now, but the energy sector is a problem. And so I just brought 3 news here. And if you read these 3 news, you will understand why oil is still in free fall, while actually the OPEC Plus is cutting back the production. It's supposed to be reducing supply, so it's supposed to be increasing the prices. But that's the point. So the oil prices are actually lowest in 5 months despite OPEC Plus production cuts. That's the question why. And the reason why is, the first reason is that ExxonMobil, for example, aims for higher oil production with capital spending boost. So here is the difference. There is OPEC Plus, which is reducing the oil production, but here is the United States is actually increasing drastically the oil production. So the United States is suppressing the prices in order to keep them low, but this is really damaging everything right now. And here's the third one. The US oil production as a record output at low prices, a troubling combination. That's what analysts think, that this is really a really big problem. And here is why. Because if they pushing prices down, the oil market is really detached from the supply-demand balance, which is a very sensitive balance, and therefore we're going to get a very uneven supply in different regions, and that could mean a problem. So, for example, the European Union is ordering a lot of oil from the OPEC Plus. While the United States doesn't. Just there is a basic in and out flow between the two oil power, and therefore, then if you go to the United States, oil is supposed to be go down, but in the European Union, oil is supposed to be go up. So this is creating a very uneven situation when you sell it on the selling level. Now here is the catch, because oil prices are going down on the market, but whoever is selling you the oil or any kind of gasoline, petrol, whatever you buy, it's actually still expensive. So the CPI numbers declining because the producer selling the oil for cheaper, but the retail is actually buying for cheaper but selling for more expensive. So that means the CPI could come down because of the energy prices. But in reality, what you're gonna get is still a very high price of oil and gasoline and petrol and diesel and everything else. I just went to the petrol station yesterday, and I just realized that I have a hybrid car, and therefore my petrol tank is only 50 liters. So I just don't need more, because I still can make 1,000 kilometers with this 50 liters tank. Or if I just driving around in towns, that even more than 1,000 kilometers. So what happened is that when I got this car, I think it was in 2021, I was very happy with that, by the way. And I realized that there was like 1.1, 1.2 euros per liter of petrol in Vienna. And now I went to the petrol station and I took, I took 35 or 36 liters, something like that, and I paid 82 euros. So we are over 2 euros of just petrol, and this is just keep rising and rising. Why? We see the inflation numbers are coming down, and if you break down the inflation numbers, you will see that the energy prices are actually coming down. So this is why you don't... You see the difference between the CPI decline and the real inflation. So that thing is started to detach. So it will balance out again, but when it's balancing out itself, that we will realize that inflation is actually not coming down. it's still very high, and that's when you're gonna see that inflation numbers, the CPI numbers, gonna start coming up again when those two situations is balancing out each other. So that's a very negative news right now for the energy market, because the United States. But we know this game because we experienced that before. You remember when there was a couple of months ago, there was a big decline in oil prices. Well before probably a larger decline in oil prices, and that's exactly the same what we experienced. So the United States stepped in and suppressed the prices. So that's why we saw, and even the OPEC Plus started to cut productions at the beginning of the year. It was a slow process to get there that the prices are started to rising again. So that's the reason. That's why it's very negative. So that's why we got the point decline in terms of market news and events. In terms of the crypto, however, it's extremely positive, and I tried to explain to you last time that what happened with Binance is, well, from the viewpoint of CZ, is very sad. From the viewpoint of people who like CZ, is very sad. But even for them, it is the most positive outcome could happen with the crypto market, because I believe still, if this doesn't happen, the whole market sector is just going to go down to the toilet. But that saved the market sector. In fact, not only saved, but it did something that it's really, really a big development in terms of trading crypto. And if you trade in crypto, you will love that this is the direction where we are heading to, because that means you're going to get a more stabilized market. Because obviously, the new CEO took over, and you can go and read the interview, by the way, on our website. And it's whatever he says, it's in line with whatever CZ said. If you just can read, between the lines, and banks are started to open up to Binance and the crypto market, so they are stabilizing. They making more safe to trade crypto, to hold your money there or whatever. And this is why it's creating an extremely positive environment. And that's in the news. That's one of the most important news, by the way, what could happen, what could come out in the crypto market. And more developments all over the place in the crypto market. Of course, there is a bad news as well. I mean, yeah, it's supposed to be bad news from people for people in the United Kingdom, because HMRC, which we know very well, would make trading crypto even harder with the new tax law, what would they trying to implement into the system, and that will create some extra tax to the people of the United Kingdom if they are trading with crypto, which seems to be a little bit odd, but at the same time, this is part of the regulation. So for the long run, this is positive. On the short run, it's not the most positive thing could happen. But again, I would not say that this is not supportive of the crypto market. So overall, we got a very positive environment, and no surprise if we go to the market news and events. We even increased with one more point, so that was actually 14 points on Monday, and now we are increasing to 15 points, which is very, very positive. So one of the biggest driver of the market on the crypto is the market news and events, and it's almost on full power to the upside. So yes, that's proven a bull trend, both fundamentally and both technically on the crypto market. I don't think it's gonna end anytime soon, but let's just wait to the reaction of the economy, what is coming in 2024. If the crypto market will be high and will stay in bull trend, or just consolidating but does not, declining with the rest of the market, it will be very good. I'm sure we're gonna hear voices. Oh, mark my word, please. At that point, just mark my word. So I'm sure we're gonna hear voices on the YouTube that if the crypto market can stay up while the rest of the market can go down, they will say that's because it's a good hedge against inflation. Now, crypto is one of the worst hedge against inflation, because it's a little bit behind the inflationary changes, but it's actually following the cycle of the inflation decline and increase. So that's the worst possible investment or trading opportunity for hedging inflation. But at the same time, this is the time when the regulations start to be good. So now, what I told you 2 or 3 years ago, when we talked about that, you always asked me, guys, what's going to happen if there is a regulated crypto market? And I always said that would be very good for us, for traders, and for investors as well, because what's really going to happen is that whoever was afraid to step into the crypto market because of safety reasons, mainly because of safety reasons, and there is, I understand if somebody is in the crypto world, it's in a pink cloud that everybody's, doing crypto, but no, guys, still there is a very low amount of people doing crypto trading and investing compared to the rest of the market, how much they do, because they're afraid to step into the crypto market. But now that we stabilize the crypto market, especially thankful to Binance, that's something what we need to keep focusing on, because those traders and investors who was afraid to step into the field, they are not going to be they are going to be on the crypto field as well if they're secured properly. And whoever is not everybody, but because nobody's liking very volatile market, but whoever is trading, I think it's going to be less investor and more traders, much more traders than investors. And because there is not much use case for an investor on the crypto market just yet, but it's developing in the background, by the way, just so you know. So it's going to be okay, but still need a couple of years. And so whoever likes the volatile life of crypto trading, they will be there. And so this is an increased volume, trading volume on the crypto market, which is very positive for us. But we just need to make sure that we cannot state, we don't know what the crypto market is going to do if there is a market crash, or there is a recessionary market crash, rather, I should say, because it never happened with crypto before. So let's just keep that hypothetical, okay? The market is very positive, but if the positive outcome will come and the crypto market will stay up while everything else is going down, that's not going to happen. That's not happening because this is a good hedge, or because because of the reason crypto lovers usually say. But that's happening because that's the time when the market can stabilize and be safe, and just get more traders and investors inside. First time in crypto's history. So I think it's a very good thing. But anyway, let's go forward, because that was the market news and events. Let's see the market sentiment. So as you can see, the ETF index and stock market is developing in a very weird way. The finance is declining in terms of sentiment, while the health sector is accelerating a little bit. The tech sector is down compared to the Monday level. The retail sector is neutral, and it doesn't do anything. It's just consolidating in terms of sentiment. Consumer services are going down, while the car industry is also in neutral. I mean, it doesn't do anything. It's in a positive territory, but still, it's not moving since Monday. Transportation is going up a little bit, and the energy sector is in big decline, but that's for the oil prices, as we know exactly. And so this is overall a very mixed sentiment level, if we can measure it. And if we go to the ETF market, the sentiment is actually declining back to -2 points. That was positive in 2 times last week and on Monday, but it's declining. So probably we just got the top here. I think we got the top here, and we're going to decline since that time. Now, why it's important that especially on the ETF market, the sentiment is declining, or probably declining for a longer period. That is because the market, the ETF market, in the last couple of weeks especially, is being driven by the retail traders. And retail traders are actually driven by the market sentiment and not the clever use of market. And therefore, if the market sentiment declines, it will represent the retail traders as long as we don't experience smart money to step into the market. And therefore, if it's declining, the reaction gonna decline as well. So maybe if we can get one more negative data, I mean, at the next meeting, which is going to be next Monday, the next point is going to be declining compared to the current -2. Then we can say that, yeah, this is a trend, and it started a declining trend, and even the retail traders start shorting the market or realizing profits. And you know what that means. I hope you know what that means. So this is a very important indicator on the ETF market right now. And if we go through the stock market, as you can see, the market sentiment is already declining. There was just a little consolidation on Monday, and then we are continuing to declining. So the stock market is even. So individual stocks are judged by the retail traders even worse way than the larger ETFs. So yeah, that's supposed to send a message to everybody. What should be watching or what should be expecting from the market, and especially because of the market sentiment is declining, and especially because of the retail traders. So yeah, that's a very very obvious situation right now. In the commodity market, there are big changes. Essential food is down, non-essential foods are down, energy is down, precious metals are down, industrial metals are down, livestock are down. Every single commodity sector is down at the moment. Now, why it's happening? That's because, yes, commodities are a very good hedge against the stock market and against inflation. The commodity market is representing the inflation itself, basically. And when it's going down, it's just balancing itself to the CPI numbers, what we're experiencing. And that's because that's the natural belief of the commodity market. But because I expect a very high inflationary environment in the upcoming years, I'm sure that we are witnessing a correction, and it's going to turn around 180 again and start to come up probably at some point in the beginning of 2024. So we need to be a little bit patient with that market sector. If it wants to go down, just let it go down as much as it wants to go down, because it will rise again very soon, sooner than you imagine. So I think it's better if somebody doesn't like shorting commodity market, needs to shift its focus to other market sectors. Now, because of this big decline, it's not a surprise that the market sentiment and psychology points is actually going underneath the zero line now with the new -3 point. It's a big decline. Let's just give this decline a little time and play out. But other market sectors can provide and do provide very good opportunities. Crypto market is one of it, because it's very stable in the bull trend right now. It's stabilizing itself day by day, and which I love to see. And yes, there will be corrections, there will be consolidations, but this is a bull trend in general. I don't know how long it's going to last, but it's stable at the moment, and because the sentiment stabilizes, and therefore it's increasing again. Now there are, I'm going to explain that a little bit later, but the sentiment point is jumping up to a very, very high 17 points in positive. So you see that there was a little decline. That's okay, but we are in the rise again, and probably going to hit some more resistances, and we're going to stop suddenly, as we did yesterday, for example. But it's still a bull trend. If we are making a correction or decline, even in the technical chart when it's a bull trend, just let it do. Don't touch it. Don't trade it, because you're going to lose anyway. I know you're always trying, but you also always losing it. I see on your points with the performance challenge and the pro server. So it doesn't make sense what you're doing, trading against the trend. Just let's wait. Let just, this correction folds out, and when it breaks to the upside, just go with it. That's the only job you have. And that's the real life of a trader, the easy life of a trader, not like trading every single day, like, you get a seizure at the front of the screen that, oh my God, I have to trade because I need the money. And that's not how it works. You shouldn't do that. If you want to learn how to make it easy, then you want to learn how to make it easy, not learning the hard way. and you're losing the money anyway. So that's your decision. But again, that's something worth to think about it. So if we go forward, the Forex market is developing very, very interestingly, let's say the least. So the DXY went to the upside in the last 3 days, and obviously the sentiment, the bank sentiment improved a lot. It's not full power and positive, but it's somewhat in the positive territory, and a big improvement compared to Monday level of bank sentiment. But the EXY is almost in the most negative territory. So that means that, as I said last week, the EXY is one of the weakest currency at the moment on the market, and it's 100% proved. So yeah, you know what to do in that case. You got a positive, you got a negative, you got to go with it. The Japanese yen is declining, but interestingly, it's declining compared to the Monday's level, but it's somewhat in the neutral to negative territory. So it's not as negative as the euro itself, while the British pound was very, very nice at the beginning of the week, but it's declining back, and it's declining harder than the Japanese yen. Not as negative as the euro at the moment. The ZXY, so the QB, is holding itself very, very nicely. I mean, it's declining in terms of the bank sentiment, yes, but it's still in the neutral territory, so that's a surprise for me, even for me as well. While the Canadian dollar is obviously moving into the negative territory already. The Swiss franc is somewhat in the neutral to negative territory, declining a big, but it was something really expected because of the zone. I explained that 100 million times. But if you're wondering what, you can go to the not the website, but on the Discord server, there are live charts for the pro members, so you can check it out. And the AXY is also declining, but the AXY lost something, or I don't know what's happening, but the last rate pause was a very negative to banks. Somewhat I can understand, because they can react positively only for the rate cut from this point, which is not going to happen anytime soon. So probably the AXY is facing for more problems for long term, and that's very important. So the Forex market is completely declining, except the DXY, but that's what it represents, and therefore you see that we are dropping back to -4. Probably, not sure that was the top point, but let's see how the DXY develops, because the DXY has problems to the upside, and if you with me for a longer time, you know exactly what I'm talking about, what kind of obstructions ahead of the rising DXY. So it's not going to be an easy thing, even if it wants to rise. So you can't say that just yet. But that's a big decline in terms of bank sentiment and psychology on the market, in the Forex market. So let's see a little bit overall what's going on. The crypto market balance is very, very positive, attacking the yellow line again with a huge volume, but that will create at some point some kind of correction. Now, this could be a problem, because as you know, as you see that the MACD is about to form a divergence now, because the price is already way higher than the previous high level, and that means that if the price cannot go high enough to make sure that the MACD can do a higher high as well, but instead starting a correction to the downside, it could be a problem, because then we got a confirmed, in case the MACD is crossing each other to the downside, it's confirming a divergence, which would confirm a structural change. So then we will see a break of this structure, but that doesn't mean break of the bull trend. It's break of the structure. Probably we're going to see a longer term consolidation or a longer term decline, but probably will not come out of the bull trend, or at least this is what I see at the moment. So keep that in mind, please, because the market is very overextended. As you can see, the volume is very high. This will break at some point, that's for sure. The momentum is too strong for too long, and therefore it has to break some. And even the stock MTM wasn't able to come down to the -40 line. which means that we have a very strong momentum on the market. The sentiment is very strong, but it will break at some point because there will be profit-taking times, probably at some zone or at some resistances, and you need to be ready for that. So do not expect that the market will only go up and will not stop. It will stop. In fact, the next stop could be a little bit larger than expected by some. And please remember for that. Is there a danger that we're going to break the trend as well and we continue in a bear trend? Yes, there is a possibility for that, but I don't think that in this environment, without a stock, for example, a stock market crash, we will see that. If, however, the stock market find itself crashed, I have no answer how the crypto market could react, because the crypto market had never seen a recessionary market crash. So we don't know how the market will react in reality. We have ideas, we have calculations, but at that point, I can't say with a high certainty what's going to happen or what's not going to happen. So we need to keep open this door with that calculation. The crypto volume is developing very nicely. Finally, we break above the blue line. We are above the green line. I'm very happy with that. But the question is whether we will stay above or not. Now, there are cycles of volumes, as you know. Now we're going to start the declining phase as we are moving into the weekend period. So I'm really wondering what the average of the volume will do on the crypto market, whether we're going to stay above the green line or not. That's the most important question, because if we stay above and start the next cycle from above the green line, this is a very healthy market, and probably we're going to continue to do very nice movements on especially on the alts. And here is the total market cap technical, and as you see that we are about to hit the zone. Even if we try to break this zone, it would be very nice. Let me just quickly check what is the current chart shows. Yeah, we didn't. So even if we try later on breaking this, don't forget that this is a very strong zone. So it's not like we just breaking it, or it's not like somebody says that I see that it's gonna break, so I'm open and I'm waiting until here. That's a stupid move, because you see the wall. And you don't know whether we're gonna break or not, especially at the first time, probably not. So secondly, we have a cycle close on the chart, which is expected to be on 10th of December in 3 days. So we should show some decline, and you can see if the MACD will not be able to make a higher high, and this thing is going to do some decline for example, making a negative cycle in the next cycle, which means the whole December will be like neutral or negative on the charts. That means we have a divergence, and probably we already breaking this structure to the upside and making a corrective structure, which will be either a consolidation or a correction. So if we are failing to break this zone within the next, let's say, 8 to 9 days, and failing to stay above, probably we're going to see some, fairly neutral or negative cycle in the next cycle until the beginning of January, which is fine, because you're better preparing with your family for the Christmas and the New Year's Eve, rather than, just every single day, 16 hours a day, just shaking above the buy button, because that's stupid. So yeah, probably we're going to get a slap on the face from this level. But again, there was a beautiful move to the upside. And I know that most of you managed to use this opportunity in a very, very wise way. So positive, but probably correction ahead. But I said correction, not trend breaking yet, at least. After that, there will be no surprise, as you see that the DXY is trying to break the scale EMAs. But I just need to tell you that it's not the case at the moment. Because we are about to get a rejection from the 21 EMA. Let's see how it goes. When we try to break something to the upside, like the 21 EMA right now, the least important is the 21 EMA, to be honest. The most important is the 8, whether if we're making a correction, we can break the 8 to the downside or not. If yes, then further weeks of decline expected from the DXY. Even if we're making a correction, that's absolutely fine as long as we are above the 8th EMA in that matter. Because if we're bouncing back and leaving the 21 for good, that means long-term rising expected in the DXY. So it's so easy. It's so easy to learn about the scale EMAs, because you know why it's easy to learn? Because they always doing on that way. Always doing on that way. So this is why I think it's not a big surprise that the euro is technically tanking and probably continue to tanking if the DXY manages to go higher. But expect some decline from the DXY as well, please. So don't live in a pink cloud when you're trading. It's not like there is only one direction. No, there's a lot of direction. And when the price is not moving to the direction you are favoring to the trend, you're supposed to not touch this chart. Just sit back, sit on your chair, drinking a whiskey, get some smoke, and, just relax and wait for the opportunity. You need to wait for the opportunity. If you wait, you're going to get more money. If you open less trade wisely, you're going to get more money. If you do the way what you do right now, that you just trade it because I have to trade, I need the money today, I need the money today, I lost yesterday, I need the money today, you're going to just keep losing it. That's a psychological battle between you and yourself. Nothing has to do with the market, because the market don't really care, to be honest, what you're doing. You are the one prevent yourself to trading on a clever way. You need to learn. That's something I always try to teach you on the pro server, and I hope you get it. So moving back, to the technicals, I just need to highlight one more thing, and this is the ETF market, and a very strange thing. I mentioned that previously, but I need to mention again that we don't see the serious uptick in the wicks just yet, but sooner or later we're gonna come anyway. So I'm not overexcited about that wicks is not accelerating to the upside yet. The market is completely stopped moving in any direction, so it's just consolidating overall, which is scary because that's for weeks now, and that means that even the retail traders are uncertain about the direction. It's even the retail, whoever responsible for this, small, I don't know if we're supposed to call this rally, because that's just nothing. Is it no power? No. And the big thing is if the retail trader is not sure about the direction, that's a problem when we see that there is lowering or decreasing amount of, but only the majority of call contracts on the market. So smart money is not there. Even the options market is declining by the end of the year. And so, and for example, there are the banks who was buying the stocks for you. If you doing the stock buying via any kind of bank, they're gonna get the expiration now, and they're gonna decide whether they buy or sell. So it's a natural decline in the options trading volume, but this is also at the same time dangerous, because once we get above this line, you see this blue line, there will be not only more put contracts on the market, but suddenly the volume will spike to the upside. And if the retail not sure where is the direction, but the put contracts coming up with high volume, this cannot go anywhere else but only down. And that could be the problem for those who is holding, because who is a trader will know exactly that, okay, that's the point. I need to close my trade, take the money, and I go to the shop and buy something for the kid to the Christmas. That's the clever trader. And there are the stupid traders who start to decline. We see the signs that, for example, the put contract is going up in an environment when the retail trade was uncertain, which is there's no any option, just go down. And then they just, this is gonna come back. It's gonna come back. Hold on. yeah, but we need to buy some gift for the kid for the Christmas. Yeah, who give? I don't care. We just we just hold it because that's gonna come up, and one day it's never gonna come up, and that's the problem. So be clever. But this thing, even with a very low volume trading right now, it's showing dangers, big dangers. And if you take a look on the balance, the MACD is already crossed, which is at least some kind of correction. The stock MTM is not below the 40 line just yet, but it's crossed. It's losing the momentum. If we're crossing the 40 line, that's a correction. Now, not a big one. That doesn't predict any big one, because even that decline with the stock MTM was like, a smaller, well, let's say smaller correction. There was a smaller crash, but yeah, a smaller correction. So a smaller correction expected. And as you know, if you can use the FIBO, and if you're measuring the 50 to 61.8% decline, that would be even natural decline. That would be absolutely okay for the bulls as well, because they can come back and buy again. But if we go over the 61.8 line with the correction, now then you will have a problem. Okay, so even with the correction now, if you bulls, you don't have a problem. But when you go over the 61.8% line, because that's the 100% from the bottom to the top one structure, you measure it, that's 100%. 61.8%. If you cross this threshold, you have no longer a natural correction. You have an unhealthy correction, and that could cause a problem. I don't know if it's going to happen or not, but right now it's heading to that way. And also we are breaking the RSI structure. We structure was a very weak structure. It was like smaller and smaller and smaller. Even the RSI was not able to stabilize the price action movement, which you can imagine how much it was the real decline in terms of retail traders. So yeah, that's a correction. We're gonna go down for at least the next couple of days or weeks, and then let's see how we do after we start to get the Q4 results, earning results, and probably it's going to be a surprise anyway. So just keep your mind, that's a dangerous story. And therefore, the ETF market overall is declining again. And it's declining a little bit stronger, a little bit underneath where it was before the increase. Means that, there was some kind of movement to the upside we saw on the charts as well. But it's trying to predict that the next move is probably going to come down instead of going up. And from that moment, this is officially a consolidation. And if it gets longer, the longer it gets, the more stable decline can come after that. So yeah, just be very careful, because the trend directions are very unstable. The retail rally is failing at the moment. If we're going to come down, the main power going to come from the macro and the earnings, but the surprise could come from the geopolitics, news, sentiment, and technicals. So that's, if we coming down, this is what supports you, and this is what's against you. Okay, that's very important. So watch if we go down and you're trading down and you're shorting the ETF market, for example, if that's going to happen, and if that's what you do, then the power, the stabilization is coming from the macro economic area and the earnings, so the performance, company performance, and you need to look for dangers from the geopolitics, the news, the sentiment, and the technicals. That's why the most risky sector right now is the tech sector, because that's looking like that's going to lose. That's going to lose big. And as I said, the main risk on the market right now, especially if you're still trying to trade to the upside, that there is no put options yet. That's true, but the retail is selling. Even the retail is selling, and with the put contracts decline, call contracts are also declining. So if we come back with calls, that's fine. Probably going to be positive, and I'm not saying it's impossible. It's more than possible. But if we're coming back with put contracts, overwhelming put contracts, this market is going to go down probably a little bit bigger than expected. So that's the ETF. And let's continue with the stock market. Very similar, but the only difference is that the stock market, so the individual stocks, do not or did not signal any rising last week, and it wasn't any rising last week. I mean, serious. So we just keep decline. In fact, we are accelerating to the downside. So if you take a look of the individual stocks, especially the large capital stocks, they are keep declining, and this is going to be a very bad effect on the ETF market as well. So it has a very mixed direction in terms of trends, because it depends on what sector you are in. But you need to watch the technicals, because the technical is gonna dictate the momentum, the trend, and all the resistances and supports. So the main risk is if the smart money steps in with puts and sells, that's going to be very, very bad. And it's not just simply dangerous. Look like this is what's preparing in the background. So be careful to prepare with yourself for the ETF market and the stock market. Now the commodity market is obviously keep declining, but it's fine. So further declining commodity price is expected. But as I said, let's just play this out. It's going to turn around. We just need to leave the room for the commodities to come down to a certain level. They're going to start building up again. We just need to be very, very, very patient. So and that's happening because the commodity market, as I said, it's reacting slower to the economic changes. So yeah, that's what we need to waiting for. The forex market is actually declining big time. It's maybe a correction in terms of the previous increase. Let's see how it turn out. It depends on really the DXY, but it's showing further decline in the upcoming days. And the macro data will be very important to drive the forex market. In fact, I'm going to show you the next week, which is very dangerous. So next week, we're going to see a lot of data. M2 money stock from Japanese, claimant count change from the UK on Tuesday, average earnings index from the UK, UK unemployment rate, US core CPI, US CPI monthly, and US CPI yearly. Sorry, I messed up with the yearly and monthly writings. And then on Wednesday, UK GDP, US, which is less important, but still we are watching because of the economy. But PPI numbers are coming from the US on Wednesday. Federal funds rate on Wednesday, 8 o'clock. And New Zealand GDP. And then Thursday, it will be very hard. I mean, really very hard. It's like Australian inflation expectation, Australian unemployment change and unemployment rate. The Swiss policy rate will not be changed. We will see that. UK official bank rate, EU main financing rate, US retail sales data, unemployment claims, ECB press conference, and then on Friday, Chinese industrial production, retail sales from China, Empire State Manufacturing Index, industrial production from the US, and flash PMI numbers, both manufacturing and services from the United States. You can imagine how this will be volatile for the forex market, and probably I think we're going to start the forex market next week on a negative way, which means probably DXY trying to represent some power, and the rest of the market will be in correction. And let's see what point we have on Monday, because the Monday point will determine the rest of the week and a little bit predict for the possible reaction for those very important data what we saw here. So yeah, that's the forex market point right now, and the crypto market point is accelerating to the upside very nicely. So we started to go up. We got 2 consecutive increasing. I'm very happy with that. The market is mainly bullish. There is not much crypto asset left without bull trend or close to the bull trend. But the most important thing is that those trends are very stable at the moment. When you go up, the power comes for you from the geopolitics, the news, and the sentiment. And the surprise could come from the macro, because that has an opposite power effect on the market sector and technicals and news. those are dangers to look for. Otherwise, this market is pretty stable right now. I'm very proud of the crypto market, by the way. And very, very nice to see. Very good to see that. So for the second half of this live stream, we're going to take a look on a couple of charts. There was no suggestion this week, but I brought it whatever I wanted to show you. And for those who are going to watch this on video on the YouTube, then goodbye. And if you want to see the charts, consider to subscribe to the Pro membership.